In today's economy, there's one question that looms over every single investor, every business owner, and honestly, every single family out there. What on earth happens now? For more than a decade, we all lived in a world of cheap money. It was an era where borrowing was easy, the cost of capital was pretty much zero. But that's over. That era is definitively done. Now we're all facing a much harsher reality, a new reality of high interest rates, and you can feel the pressure building across the entire system. It's really no longer a question of if something will break, but what breaks, and in what order. So today, we're going to build a clear roadmap to navigate this new landscape. This is the refinancing wall, what breaks first.
Okay, let's just dive right into the heart of it, the question you see on the screen. For years, the global economy was basically running on fumes of cheap debt. Borrowing costs were so low they were almost an afterthought. And that environment? It encouraged massive risk-taking, it blew up the prices of everything from stocks to real estate, and it let businesses and regular people take on a staggering amount of debt. Well, the music stopped. Central banks are holding interest rates at levels we have not seen in decades, and they're making it pretty clear this isn't some temporary blip. So when the very foundation of the financial world shifts this dramatically, where do the first cracks start to show? Is it in the big stock market indexes you see on the news? The housing market? Your local businesses? The truth is, the stress follows a pretty predictable path. It's not random. So it's not a matter of if something breaks, but what breaks, and more importantly, in what sequence. And understanding that sequence, that is the absolute key to navigating what's coming.
To answer that question, we are not just going to speculate or go with a gut feeling. We're going to use a structured framework, a powerful tool that, macro strategists and big institutional risk management teams use to prepare for this exact kind of turbulence. Today, we're unpacking what's known as the stress pathway model. Just think of it like an economic seismograph, right? A tool that's designed to detect those first tiny tremors long before the earthquake hits the headlines. Our whole goal here is to give you a clear, predictive roadmap that maps out the entire chain reaction, from the very first signal in the financial markets all the way down to the final impact on Main Street. And before we jump in, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Your support really does help us create more deep dives just like this one.
So here's the journey we're about to go on. First, we're going to establish why these persistently high interest rates are the new reality we all just have to get used to. Then we'll start tracing the path of that stress as it moves through the system, starting with the very first domino to wobble, the credit markets. From there, we'll follow that shockwave as it slams into real estate, and then we'll see how that pressure squeezes Main Street businesses. And it's only after all of that that we'll see how the broader stock market finally feels the pain. And then we'll end by putting it all together into a clear, actionable roadmap. So let's get started with Section 1.
All right, Section 1, the new reality. It's absolutely crucial to get this in our heads. We are no longer in some temporary high-rate environment. For the better part of a year, the market was just clinging to this hope of a pivot, this idea that central banks would quickly turn around and bring back the good old days of cheap money. Well, that hope is gone. The market's mindset has totally shifted. This isn't a brief shock to the system. This is the new baseline. The era of near-zero interest rates that really defined everything after 2008, that was the exception, not the rule. We are now returning to a more historically normal and, frankly, a much more challenging cost of capital.
So, why is this happening? Well, central banks, like the US Fed and the Bank of England, they're locked in this really tough, prolonged fight with stubborn inflation. The easy part of that fight? It's over. Now they're dealing with the sticky parts of inflation, things like services and wages, which are way harder to bring down. To do that, they're holding rates at what they call restrictive levels, which is just a fancy way of saying the cost of borrowing is high enough to actively slow down the whole economy. And the market has finally gotten the message. Those early hopes for a bunch of quick rate cuts have just completely evaporated. Now forecasts are pointing to maybe a few, if any, cuts this year. In fact, some inflation surveys are suggesting we could stay above the central bank's target all the way through 2027. And that's what turns us from a temporary shock into a long-term structural stress on the entire economy.
Now, to really get how this stress spreads, we need to understand a key concept: monetary transmission. It sounds super technical, I know, but the idea is actually pretty simple. Think of it like this. When a central bank raises its key interest rate, it's like dropping a huge boulder into the middle of a calm pond. The initial splash, that's the policy decision itself. But the real impact, the real power, comes from the ripples that spread out from that splash. Those ripples, that's monetary transmission. They travel first through the banking system, right? Changing mortgage rates and business loan costs. Then they move through financial markets, changing the value of stocks and bonds. And eventually, those ripples reach the furthest edges of the pond, the real economy, affecting our jobs, the prices we pay, and the overall growth of the country. And this whole transmission thing happens through three main channels. And these are basically the engines that power our stress pathway model. First, and this is the big one for our topic today, is the refinancing wall. This is just a mountain of debt that companies and real estate investors took out when money was cheap that now has to be rolled over or refinanced at today's much, much higher rates. I mean, imagine a business with a loan at 2% that suddenly has to replace it with one at 7%. That's the wall. Second is cash flow compression. This is where higher interest payments start eating up a bigger and bigger slice of a company's or a household's income, leaving less for everything else, like investing, hiring, or even just daily expenses. And third, asset repricing. In a high-rate world, the value of future profits is just lower when you calculate it in today's dollars. This puts downward pressure on asset prices across the board, from stocks to commercial real estate. These three channels, they're the pathways the pain travels through.
Okay, let's move to Section 2 and see how this pressure starts to build. This brings us to the very first domino to fall, the credit markets. Long before you ever see headlines about rising unemployment or a stock market crash, the earliest, clearest signals of stress show up right here. You should really think of the credit market as the canary in the economic coal mine. Why? Well, because it's the market for borrowing money itself. It is the most sensitive to any change in the cost of money, and it's where the financial system feels the pressure first and feels it most directly.
According to our model, this first stage happens fast, usually within the first 6 months of the market fully accepting that rates are staying high for good. And the probability of this happening is very high, around 80%. Now, what breaks first isn't the whole system, but its riskiest, most vulnerable corners. We're talking about high-yield bonds. You probably know them as junk bonds, debt from companies with weaker financials. We're talking about leveraged loans. These are loans to companies that are already carrying a ton of debt. And we're talking about the booming and often murky world of private credit. These are the specific areas where weak balance sheets and floating rate debt come face to face with the hard, unforgiving reality of much higher interest payments.
And this brings us to a really crucial insight into how markets actually work. The key point to get is this: financial markets are forward-looking. The risk of companies defaulting on their debt gets priced in long before the actual wave of bankruptcies even begins. So what does that really mean? It means investors, the smart money, they don't wait for the official bankruptcy announcement on the news. They see the writing on the wall, and they start demanding much higher interest rates, or what are known as spreads, to compensate them for that rising risk of not getting paid back. This repricing of risk is the very first visible crack that shows up in the dam.
And this isn't just some theory, it is a historically proven pattern. Just look at the evidence on the screen. Back in 99 and 2000, stress in the high-yield bond market started flashing red months before the dot-com bubble burst. Fast forward to 2006, 2007, while the public was still talking about a historic housing boom, the credit markets were already signaling a full-blown crisis in mortgage-backed securities. The warning signs were all there for anyone who was looking at the right things. And even more recently, in late 2018, the credit markets froze so badly that it forced the Federal Reserve to completely reverse its policy and pivot. Time and time again, history shows us credit leads the downturn.
So, what specific signals should you be watching for? Think of this as your dashboard of leading indicators. First, watch for high-yield credit spreads widening out significantly. A jump of 2 percentage points or 200 basis points from their recent lows is a major warning sign. Why? Because it means investors are suddenly demanding much more compensation for taking on risk. Second, look for a spike in loan covenant violations. These are just the financial health rules that companies have to follow to keep their loans. When they start breaking those rules, it's a direct sign of deep financial distress. And finally, keep a close eye on the percentage of distressed debt in the market. When this number climbs above 10%, it means the stress is no longer just about a few bad companies, it's becoming systemic.
Okay, so after those first tremors are felt in the credit markets, where does the shockwave go next? Section 3, real estate. This entire sector is incredibly sensitive to interest rates for one simple reason: its scale and its reliance on leverage. Almost all property, from the biggest skyscraper to the smallest house, is bought with a ton of borrowed money. And this leverage just acts like a giant magnifier, amplifying the impact of any change in interest rates. And the rate crunch? It doesn't discriminate. It hits both commercial and residential real estate, and it hits them hard.
The model predicts that the first major impact will hit commercial real estate, or CRE. This happens in stage 2, usually between 6 and 15 months into this high-rate period, with a pretty high probability, around 70%. The most vulnerable spots? Office and retail properties, which are already struggling with how we work and shop after the pandemic. And we also see stress in what's called value-add multifamily. These are older apartment buildings that investors bought with plans to fix up, all funded by cheap, short-term debt. And the why here is just brutally simple math. When their short-term loans come due, they have to refinance at rates that are 3 to 5 percentage points higher. That massive jump in their debt cost can instantly wipe out all of the property's equity value. This is the refinancing cliff in action, and literally trillions of dollars in commercial real estate debt are heading straight for it.
Next up, in Stage 3, the stress moves to the residential housing market. This usually happens between 9 and 18 months in. But what's absolutely crucial to get here is what breaks first. It's not necessarily prices. At first, prices can stay surprisingly firm. Why? Because millions of homeowners are locked into these ultra-low mortgage rates from 2020 and 2021, creating what people call a golden handcuff effect. They just can't afford to sell and move because their new mortgage would be double or triple what they pay now. This keeps the inventory of homes for sale incredibly low. So instead, what breaks is activity. The number of homes sold just plummets. New construction stalls as builders face higher costs and shaky demand. And this freeze has a huge ripple effect through the wider economy, hitting everyone from real estate agents and lenders to furniture stores and contractors.
This chart really shows the seismic force that's driving this slowdown. Let's call it the mortgage payment shock. On the left, you see the average 30-year mortgage rate back in 2021 hovering around a crazy low 3%. On the right, you see the new reality, rates at 6%, 7%, maybe even higher. For anyone trying to buy a home today, the cost of borrowing has more than doubled. This is not a small tweak. It is a fundamental generational shift in the financial landscape of housing.
Let's put a hard number on that shock to really feel the impact. For a median-priced home in the U.S., that jump from a 3% mortgage to a 6.5% rate, well, it translates to a staggering 75% increase in the monthly payment. Just let that sink in for a second. The exact same house now costs 75% more every single month purely because of interest rates. This is the affordability crisis summed up in one number, and it's exactly why housing activity is just grinding to a halt for so many people. It's a mathematical brick wall. And speaking of navigating these challenges, if you need guidance, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
Okay, so far we've seen the stress build in the financial markets and then in the real estate sector. Now, in Section 4, we trace its path into the real economy. We're talking about the squeeze on Main Street, the direct impact on the small and mid-sized businesses that are the true engine of our economy. I mean, these are the companies responsible for most new job creation, so their health is a direct indicator of the health of the labor market. This is where those abstract ideas of interest rates and credit spreads become very, very real.
This stage of the stress pathway usually shows up later in the cycle, somewhere between 1 and 2 years in, and the pain is not spread out evenly. The companies that break are the small and medium-sized businesses that are carrying a lot of debt and those high-growth firms that were relying on cheap borrowing to fund their expansion. And the mechanism here is something called crowding out. Imagine a local restaurant owner who has a variable rate loan on her business. As rates rise, her monthly loan payment doubles. Now, the money she had set aside to hire a new chef or buy a new oven is instead going just to pay the bank. Growth stalls, and then it can even go backward. That's crowding out in action.
This comparison really shows the huge divide that opens up in the corporate world when rates are high. On the left, you've got the vulnerable. These are the small and mid-sized firms that just don't have the pricing power to absorb higher costs. They are the highly leveraged companies living at the mercy of their lenders. And they are the growth-oriented tech firms that were valued on promises of far-off future earnings, which are just less valuable today. But on the right, you've got the resilient. These are the mega-cap firms with fortress-like balance sheets. They are the companies sitting on piles of cash that don't need to borrow. And they are the stable, profitable businesses that generate consistent cash flow year after year. In a high-rate world, cash is king, and leverage is a huge liability.
So how do we track this building stress on Main Street? Here are the key things to watch that, when you put them together, really tell the story. First, an increase in corporate bankruptcies, especially among smaller firms. That's the most direct and final signal of failure. Second, watch for a decline in capital expenditures, or CAPEX. When businesses stop investing in their own future, in new machinery, new tech, new factories, it's a clear sign they've switched from growth mode to survival mode. And third, and maybe most importantly, pay close attention to bank lending surveys. When these reports show that banks are tightening their credit standards, it means the flow of capital, the very lifeblood of the economy, is being choked off. And that is a critical warning sign of a broader economic downturn.
We've now followed the path of stress from the complex world of credit markets through real estate and on to Main Street. So when does the average person, watching the news or checking their 401k, finally see it in the numbers they recognize?
That brings us to Section 5, when the broader market feels it. This is the final stage, where all that built-up stress finally becomes undeniable in the headline figures, the big stock indexes, and the consumer spending data that everyone follows. The time lag here is really important. The stock market is often the last one to get the memo.
This final stage of the financial transmission is often the last to show up, sometimes taking 18 to 30 months after high rates begin to really set in. And here, what breaks is the underlying health of the stock market. Even if the main indexes look okay on the surface, we see a collapse in market breadth, which just means fewer and fewer individual stocks are actually going up. We see a sharp contraction in valuation multiples, meaning investors are willing to pay less for each dollar of a company's earnings. And we see the end of the leadership of those high-flying growth stocks. The market just enters a new regime. What survives and can even do well are the resilient players we talked about earlier, the cash-rich megacaps and defensive sectors like utilities and consumer staples, things people need no matter what.
And this right here perfectly illustrates one of the most deceptive traps for everyday investors. A key sign of this underlying fragility is narrow market leadership. The S&P 500 or the Nasdaq might look healthy, maybe even hitting new highs. But if you look under the hood, you find out the entire index is being propped up by just 5 or 6 giant megacap stocks, while most other companies are actually flat or going down. This is a classic sign of a sick market wearing a healthy mask, and it very often comes before a big, broad-based correction.
At the same time, the squeeze on household budgets finally starts to show up as a real pullback in consumer spending, which, remember, is the primary engine of the U.S. economy. This chart shows how that pullback usually happens. The very first things to go are the big-ticket items that often need financing: new cars, major appliances, home renovations. Next, consumers cut back on discretionary spending, the wants, not the needs, things like vacations, expensive dinners, and entertainment. And this, in turn, directly hurts those Main Street businesses we were just talking about. Spending on non-discretionary stuff, the absolute necessities like groceries and utilities, that tends to stay stable until much, much later, often only dropping if and when widespread job losses start to happen.
All right, we have walked through every single stage of the stress pathway model, from that first tiny tremor in the credit markets to the final visible impact on the broader economy. Now, in our final section, let's put it all together. This is your roadmap. We're going to summarize the key takeaways and lay out the complete, probability-weighted sequence of events so you can walk away from this with a crystal-clear framework for making sense of the complex economic world we're in right now.
This table right here is the core of our entire analysis, the whole model on one slide. It's the probability-weighted stress pathway. Just look at the sequence. Credit breaks first, with an 80% probability, inside of 6 months. Commercial real estate follows, then housing activity slows down. Then the squeeze on small and mid-sized companies really begins. It's only after all that pressure is built up that the broad stock market truly breaks down. Now, pay close attention to that last line. A full-blown consumer collapse, one driven by mass job losses, is actually a lower probability event. Why? Because the system can absorb a tremendous amount of stress before it finally gets to the labor market. So what is the first and most important takeaway from all of this? It's simple. The credit markets are your early warning system. They price in economic stress long before it ever becomes mainstream news. Because they're the closest to the source of the pressure, the cost of money itself, they're the first to react. So if you want to know what's coming 6 to 12 months down the road, don't watch the stock market ticker all day. Instead, keep a close eye on high-yield credit spreads and default rates. They're the lighthouse signaling that trouble is brewing way out on the horizon.
The second key takeaway is that the housing market acts as an early thermometer for the health of the real economy. While credit is the financial canary, housing is the Main Street canary. Data on things like new building permits, housing starts, and affordability, that's not just about real estate. It's a powerful leading indicator for consumer confidence, builder sentiment, and the overall strength of domestic demand. Credit tells you what the financial system is thinking. Housing tells you what real people and businesses are actually doing.
If there is one single sentence to remember from this entire explainer, make it this one. This is the ultimate thesis of our model. High rates don't cause sudden crashes. They cause refinancing cliffs. The damage isn't from a single, dramatic, TV-worthy event. It's a slow, grinding, and inevitable process where companies, properties, and projects, one by one, hit the wall where their cheap debt matures, and they are forced to refinance at punishingly high rates. It is a war of attrition.
And this brings us to the final, concise logic of the whole model.
The system doesn't break where sentiment is weakest, it breaks where the math no longer works. It breaks at the precise point where debt maturity schedules collide with the new harsh reality of cash flow. This is the fundamental mechanical reason for the sequence we've laid out today. Credit leads because it's closest to that refinancing wall. Real estate follows because it's built entirely on leverage. And the labor market, thankfully, is the last to crack, because businesses will do everything they can to hold on to their employees until they have absolutely no other choice.
We've laid out the entire framework, the sequence of events, and the key indicators to watch at each stage. So we'll end with a question for you. Now that you have this roadmap, which of these leading indicators, from credit spreads to housing starts to market breadth, which ones will you be watching most closely to help navigate the months ahead? Thinking about that is the first and most important step to actually applying this knowledge. We hope this has been valuable, and before you go, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. We really appreciate you watching, and we will see you next time.